Great. Good afternoon, everyone. Thanks so much for joining us today. My name is Stephanie Creedon, and I'll be your host for today's webinar on understanding pension risk management. During today's webinar, we'll discuss the importance of monitoring investment volatility throughout the year and its impact on pension liability risk management. Experts from the Kelleher Corbett Group at Morgan Stanley, the Angel Pension Group, and Wolf & Company will cover the effects of investment volatility on your pension plan and credit union financial statements, and discuss the effective liability-driven investment strategies. Before we get started, I'd like to go over some housekeeping items. Today's presentation will be about 1 hour, and we will have time at the end to answer any questions. Our audience will be muted during today's presentation. If you do have any questions, please use the Q&A box located at the bottom of your Zoom control panel to submit questions to the presenter. Again, we'll be addressing those at the end, but please feel free to send them in throughout the entire presentation. Additionally, a copy of today's presentation will be sent out 24 hours after the webinar has concluded. In the email, you will receive the presentation and a link to the recording to watch at a later date or pass along to a colleague. It's now my pleasure to introduce today's presenters: Derek Graves, Principal in Wolf & Company's Audit Group; Joe McLaughlin, a Senior Vice President Financial Advisor, Senior Institutional Consultant, and Corporate Retirement Director at the Kelleher Corbett Group at Morgan Stanley; and Jeff Bauer, the President and Principal at the Angel Pension Group. Thank you all so much for presenting today. And it's now my pleasure to hand it over to Jeff to get us started.
Great, thanks, Stephanie. So good afternoon, everybody. So my portion of the presentation will be relative to the new legislation that was just passed. And as Stephanie pointed out, how that legislation impacts each credit union and ultimately pension volatility and funding. We preface it by pension relief with caution, as any government legislation passed has certain intent, and then with that intent comes impact. So my portion of the presentation today will discuss how that impact ultimately affects each credit union. Jeff, next slide. So the American Rescue Plan Act was passed in 2021. The interest rate current environment was historically low. This situation was made even worse for many plan sponsors, obviously by COVID. So Congress passed in March of 2021 one unplanned funding in terms of this relief is ultimately has an impact to reduce required contribution levels, both in current and future years. One of the impact that we want to discuss for credit unions is how that relief will affect your financial accounting. That certainly Derek will address, as well as the investment strategies for funding, given the relief that will impact from the investment side that Joe McLaughlin will address as well. Next slide, please. So just in terms of historical background, what was in place versus what Congress had passed back in March for purposes of the relief. And again, this relief is really meant for cash funding purposes. So there were rules in place starting in 2012 that were meant to stabilize the amount an organization that has a defined benefit plan ultimately funds. And in that relief, it started with 2012. The average, in terms of the yield curve for averaging what the funding was based on a 25-year average. The new act affects how this average in terms of the interest rate yield curve will be ultimately applied. There are three components to that. It sets the corridor to 5% for plan years beginning in 2020. It extends the phase out of the relief. The relief was meant to end for funding purposes in 2023. That has now been pushed out to 2030. And for stabilization purposes, the relief is meant to put a 5% floor on this average yield curve that's used for the funding. So from a perspective of what the interest rate portion of the relief applies to funding purposes, we're looking at really an extension of the initial relief for 2012 out to 2030. And the effect of this will be to increase interest rates that you apply towards your funding on a liability basis, therefore causing the plan to have to contribute less. The implementation of the interest portion of the relief will be January 2022 at the latest, and 2020 at the earliest. So some of this, as we discussed how the relief gets implemented, each plan sponsor will have choices to make, relative when they would want the relief to be impacted or implemented in terms of their plan. So you will have choices. So for the interest rate portion on the relief, you can start it as late as plan years beginning 2022, and you can go back retroactively for plan years starting in 2020. So that's the interest rate portion of the relief. We can go to the next slide. So the second portion of that is really the shortfall amortization. So again, the relief is meant to really cover two pieces, both interest rate environment, given how low interest rates have been. And the second part of it is the shortfall amortization. So any plan that is currently underfunded on a funding basis, again, we want to be clear, that's not on an accounting basis, but on a funding basis, will have the ability for the shortfall portion to extend the amortization in 2019, 20, or 21. So the amortization right now for all underfunded plans on a cash basis is 7 years. So when a plan is underfunded, the plan ultimately has to pay down its underfunding on a 7-year basis. The new Rescue Plan Act extends the amortization for underfunded plans to over 15 years. This was the legislation that was in place in 2007 when Congress changed the Pension Protection Act. All underfunded plans had to pay down their underfunding over a 7-year period. Congress has reversed that back to the pre-Pension Protection Act days to go for all underfunding for 15 years. The other piece that is really a game changer here for underfunded plans is not only are you spreading your unfunded over a longer period, more than double, but any underfunding that is currently in your plan goes to zero, and the bases that were created, those amortization bases, are ultimately set to zero. So it's as if your plan has instantly become 100% funded. This can go back to January of 2019. So one of the things to think about is you could actually implement this relief on the amortization portion back to 2019. The effect that this would have for many of the credit unions that have put contributions in is it would develop a pre-funding balance or a credit balance. So it would develop something that for future years you could use if you did not want to put as much money away into the plan. So you would have the ability to go back to 2019 plan year and change your amortization or shortfalls and reset that to zero, and then start amortizing over future years over a 15-year period. Next slide. So what is really the impact of all of this? So when we see the immediate impact, it will raise interest rates because of the relief that's been extended on the yield curve out. So for plan years starting in 2020, your interest rate environment will look a lot higher. 2020 would be about 30 basis points higher than without the relief. 2021 is expected to be about 60 basis points higher, and so forth. So immediately your minimum required contribution will go down. For those that have completed the 2020 valuation already, you would have the ability to redo it we're expecting guidance from the IRS to come out on how to retroactively go back. The liabilities will certainly go down, and the required minimum contributions for most sponsors will go down as well. Your funded status that has been passed out each year to explain the level of funded percentage your plan is at will be recertified if you decided to go back all the way to 2019 or 2020. The impact for amortization, as we talked about, the biggest impact would be all shortfalls are eliminated and reset to zero. The order of magnitude, to give the group today a sense of how much your cash contribution could go down, when you spread the amortization from 7 years to 15 and you reset it to zero, many plan sponsors are expecting their cash required contribution to be reduced as high as 50%. So these rules are substantial in nature and certainly will lower liabilities dramatically and lower required minimum contributions for purposes of how much a defined benefit is required to contribute on a yearly basis. The shortfall for amortization has the biggest impact, and then the interest relief component has the second biggest impact in terms of the legislative changes. Next slide, please. What are the ramifications and what are the strategies that I think make sense for you to think about? So let's talk for a moment about the three areas that ultimately are not impacted. So again, these rules are strictly for cash required contributions going into the plan. So two areas that are not impacted is each year as a sponsor of your defined benefit plan, you are ultimately responsible for paying PBGC premiums, the Pension Benefit Guaranty Corporation. The liability that gets calculated for PBGC purposes is not the same liability for minimum funding that the relief has been enacted for. So your PBGC premiums will ultimately be the same. There's no relief there. One of the things to think about is if you took advantage of the funding relief by the interest rate and the amortization, and you contribute less, then the PBGC rates are lower. Your PBGC premiums would be higher if the plan is additionally underfunded. So something to think about there in terms of an unintended consequence where PBGC issues could arise if you take advantage of the funding relief. Your PBGC premiums could go up dramatically because the funded status is going down. The other side, certainly that Derek will cover on the accounting world, is the interest relief does not impact the plan liability relative to your financial accounting standards. In that regard, again, if you were making lowered required contributions because of the cash funding relief under ERISA, this could negatively impact both the balance sheet for your funded status each year, as well as your income statement, because your assets would be expected to grow less because the funding has gone down. So another thing to think about would be unintended consequences of this relief. We open up with this is interest relief, but with caution. These would be the two cautionary areas for relief that does not apply to PBGC rates or accounting rates on how you calculate the funded status of your plan from an accounting point of view. The other piece that involves the investments that Joe will cover is really, again, if your plan is active and not frozen, you have a certain rate of return assumption you need to keep pace with in order for the liability and asset growth to be in alignment. So if you were taking advantage of the funding relief, then the plan becomes underfunded. We feel that there may be greater pressure on the rate of return and ultimately what your mix of equity versus fixed income might look like. So a caution there on the investment side would be if there's underfunding due to the relief and you take advantage of it, your investment rate of return to keep pace with liability growth needs to really be looked at closely. And what does this really mean in terms of overall strategy? If you're going to measure ultimately whether you use the funding relief or not, then funding policy strategies really need to be looked at closely. If your funding policy in the past has been to put the minimum required in, and that minimum required goes to zero for a length of time, should a funding policy strategy be developed that is no longer based on the required minimum, but be based on some other metric that would be more accurate or look more favorable towards keeping the funded status of the plan in place? So some things to think about for the group today would be for funding policy strategies away from the required minimums under cash would be putting a funding policy in place off the accounting side, which would be whatever your net periodic expense is, you would fund the greater of that number or your minimum required to keep pace with liability growth. Second strategy could be if you looked at how your liabilities grow on a present value basis due to aging. So every year your liabilities go up 4 or 5% by being 1 year older in the plan as a participant. You could fund that liability growth versus the required minimum. A third strategy could be if your plan was frozen and you were looking to terminate the plan over time, you could look at a termination underfunding and use that as your guide to what the annual contribution would be relative to the minimum required. Or if you were looking to reduce PBGC premiums, you would look at the funded status relative to PBGC premiums versus the minimum required contribution. All of these items relative to a policy funding strategy could be in place. We expect the relief for many plans to be 4 or 5 years of substantial either zero contributions or contributions that may be cut in half. So under those guidelines, thought process would be, should a funding policy be developed that is different than just what is required under the IRS's minimums? These would be guidelines to think about in not having unintended consequences of increasing your unfunded liabilities by taking advantage of the funding relief. We feel that the funding relief was really meant to ultimately impact very cash-starved organizations that could not afford even the minimum contributions to be put in place. So funding policies, I think, are a major portion of ultimately your strategy and how you approach how the relief impacts your plan. The second portion is really from a risk mitigation point of view. How does this relief impact how you would look at how to lower volatility or mitigate risk within the plan? So from the perspective and asset liability duration, your duration of your liability being impacted by the relief ultimately should be looked at against the asset duration. Joe will cover this. This would be meant to be mitigating volatility and downside risk. We feel because of these rule changes and law changes that the development of projected liabilities and recommended contribution levels should be looked at in a 5-year funding and accounting basis. So we'll be very interested to see, your plan's liabilities out over 5 to 10 years projected for cash purposes, and where the accounting side from an expense point of view projected out. Do those two intersect later on when the law goes away on the interest rate relief in 2030? Or does the cash funding remain lower than your expense, which would go back to your funding policy? So this law really breeds greater liability projection and management on a 5 and 10 year basis. One of the tools that I think is helpful for plan sponsors to look at would be a liability dashboard. So when you look at the effect of the law change, both throughout the year and on a 5 and 10 year basis, you could monitor this. Many defined benefit plans, as you know, do a valuation once a year, and that valuation gives you sort of a rear view mirror snapshot of what your liabilities look like. From a dashboard point of view, you could have a quarterly assessment of both short-term and long-term projections that would be integrated into your investment strategy to develop either proper hedging or making sure that the funded status is staying in good shape and the liabilities are not outpacing the asset growth. So those are the things to think about. In summary, you've got unintended consequences if you take advantage of the relief, which could be impacting your PBGC premiums, could be impacting your accounting, could really look at your investments and force you to go to a higher equity strategy. So our recommendation is to look at carefully the impact of the law change, do a 5-year to 10-year projection, develop a funding policy around those projections, and then on a quarterly basis, monitor that liability and asset growth to make sure your strategy either is working or needs to be, fine-tuned along the way. So that's an overview and brief summary of the law change. I'm going to turn it over to Joe to talk about the investment piece.
Thank you, Jeff. Thank you for sharing all that information with us. And certainly in my role, I appreciate all the insight that an actuary and particularly a consulting actuary can bring to the table, particularly as we work together on our mutual clients that we have the pleasure to serve. Again, my name is Joe McLaughlin. I'm with the Kelleher Corbett Group at Morgan Stanley. Good afternoon or good morning to those of you who are attending the session today, depending on where you may be. Just a quick overview of our group. We are a large nationally recognized team within Morgan Stanley. Pleased to announce that actually as of Monday this week, we're now over $4 billion in assets that we have the pleasure to serve clients. My particular niche is working with nonprofit organizations and credit unions. Had the pleasure of serving credit unions since the late 90s, both on defined contribution and defined benefit plans. Next slide, Jeff. In terms of our team, it's founded in 1992 by Stephen Kelleher, and I joined the team in 1995, having begun my career as an investment professional on the product side in the early 90s. And in 1994, I got exposed to defined contribution retirement plans and just found all the technical aspects of it fascinating, and the fact that I could overlay my interest and passion for investments with something that was very technical and very unique and just very interesting to be on the ground floor of 401ks in particular as they were gaining momentum. And as a practice, we serve primarily in a fiduciary capacity, whether it's working with defined contribution plans or serving as a discretionary investment manager. We have a lot of experience, as I said, my experience in particular, mostly with nonprofit organizations and credit unions in particular. Morgan Stanley as an organization obviously has a major presence in the space. We're the largest consulting and investment provider to nonprofit clients. We are number 2 in the nation when it comes to providing pension investment management solutions. Next slide, Jeff. And this is one of my favorite quotes, and continuous improvements is one of my personal mantras. So if I'm interested in something, I want to make sure that I either know more about it continuously or get better at it continuously. So as we serve our clients, particularly with respect to their retirement plans, we want to make sure that we set a fiduciary standard of excellence, whether it's a defined contribution, defined benefit plan, and make sure that our clients are working towards continuous improvement. In the context of pension plans, continuous improvement typically means, next slide, Jeff. It typically means that your plan is getting better funded. If it's an active plan that's still accruing benefits, that you make sure that it's a sustainable part of your retirement benefits program that you offer to your organization and its employees. You want to make sure that it's integrated and fits with your defined contribution arrangement that you have so that everyone is able to maximize their retirement outcomes. Now, when it comes to pension plans, I always like to start with the first bullet point that every pension plan is unique. So even though we've had the pleasure to serve a number of credit unions over the years, some of which have terminated their plans, most of which are on the path to termination, just coincidentally, each one of them is entirely unique. And when you look at other nonprofit organizations or even for-profit organizations, there are no 2 plans that we have served over the past nearly 30 years that have ever been invested exactly the same. So they're all very different. And I'm going to go through in a moment what defines all those differences. And I define or break those differences into 3 distinct categories. The first being the plan objectives. The second, the organization's financial considerations, which Jeff touched on a few points there. Derek will go deeper when I hand the presentation over to him. And then what are your population demographics? So let's unpack each of these one at a time, and we'll go a little bit deeper, starting with plan objectives on the next slide, Jeff. When it comes to plan objectives, to start with, is your plan actively accruing benefits, or is it a frozen plan? And if it's frozen, is it a hard freeze, meaning there are no future benefit accruals? Everyone's benefit is frozen at the level it was at the time of the freeze? Or is it a soft freeze where you just are not allowing any new entrants into your pension plan, but everyone who's in the plan already is still continuing to accrue benefits? An actively accruing defined benefit pension plan is going to look, from an investment standpoint, very different from a frozen plan. Likewise, a hard frozen plan is going to look very different than a soft frozen plan. Even if the plan is frozen with a soft freeze, we need to have an understanding on the investment side what that benefit accrual design looks like. So how do the actuaries like Jeff and his team, how do they design your plan? And what is the slope of that benefit accrual? What does that look like? What's the life cycle of the plan? We have clients today that have actively accruing pension plans, fully active, yet they are very seriously considering freezing them, potentially terminating them. Lots of different considerations going on, given how complex pension plans have become, and sometimes how much of a burden they can be to an organization. What's the funded status? Again, if you take two fully frozen plans, so they're hard frozen, no one's accruing any additional benefits. One is 70% funded, the other is 101% funded. Those two pension plan portfolios are going to look dramatically different from each other because they have very different objectives with those two different funded status. What's the actuarial target rate of return? And over the past 5 years, there have been a lot of conversations about what is a realistic and sustainable actuarial target rate of return. And Jeff and his team have contributed a tremendous amount of insight to those conversations with our mutual clients. What about the payment of the pension plan obligations? In other words, how are you processing them? Some plans choose to pay even monthly pension payments to retirees. They're paid directly from plan assets. That requires a very different investment strategy versus a plan that purchases an annuity each time a retiree elects a monthly pension benefit. Two very different objectives there. And are you going to undertake any de-risking strategies in the near or intermediate term future? Things like a lump sum window offering or an annuity purchase to take assets out of your plan and transfer the liabilities either to the participants by paying them a lump sum or to an insurance provider by purchasing an annuity. If you're doing both of those or you're doing one or the other, that could potentially be three different investment strategies, and you might have an isolated strategy to deal with those assets that are part of that de-risking or risk mitigation component. Next slide, please, Jeff. Looking at the organization's financial considerations, Jeff just talked a lot about interest rates. It's what the intended legislation, at least on the funding side, was intended to provide some relief there, but there are still a number of areas related to your plan and related to your institution where interest rate volatility can have an impact. Things like the funded status of your plan. Either you're required or you're determined cash contributions. Does the plan offer lump sum payments? If you are paying out lump sums, you know that rate tends to be known for most periods of time, depending on the ultimate design of your plan. What if your plan is on the path to termination? As Jeff mentioned, if you are looking to terminate your plan, the recently passed legislation does not require any funding relief to get your plan ready for termination. And then you have termination settlement costs. All of these things need to factor into your investment portfolio. Cash flow, that's what Jeff spent most of his time talking about. The relief is definitely helpful to organizations that are struggling to make cash contributions, but if you take advantage of that relief, you may end up with risks in different places. What about your financial statements? Are there certain things that you as an organization are more sensitive to that are unique to your organization? Jeff talked about actuarial losses and how the recently passed relief provides some mitigation issues there. What about the sensitivity to future actuarial losses? Again, going back to your plan's rate of return, and how does that match to your investment portfolio? Are you set up to mitigate future actuarial losses? And again, Jeff also spoke about PBGC premiums with respect to funding, with respect to volatility of pension plan performance and your funded status. PBGC premiums could be a factor for your organization. And lastly, on the next slide, unpacking some of the demographic considerations. Next slide, Jeff. Thank you. What do your demographics look like? Are you oftentimes with credit unions, or not often, but sometimes we've seen credit unions that have almost a barbell effect on their demographics. They tend to have a good number of employees who are very tenured, closer to retirement, and then they also have a very large pool of younger employees who are new hires, just beginning their careers within the organization. So if you have a defined benefit plan that is dominated by both of those constituents, that's going to look very different than an organization that has more evenly distributed demographics. And that leads to duration of liabilities, depending again on your demographics. If your plan is frozen, depending on the demographics of those that are in the plan, you may have an effective duration of 11 and a half years of your liabilities, but how is that distributed? Right? Is it barbell effect? Is it evenly distributed? Are there lumps in your duration metrics? What is the distribution of deferred vested employees or former employees who are not yet eligible to obtain retirement benefits, and the number of retirees that are in your plan, all going to have a factor on what your portfolio should look like. And again, what are your distribution options within your plan? And based on those options, what are the most popular options taken by those who retire or separate from service in the organization? Again, if you have a plan that offers many forms of distribution, but it seems like 80% of the employees take a lump sum when they leave, that's going to necessitate a different investment approach than a plan that is paying monthly benefits directly from the plan, and the overwhelming majority of retirees end up taking a monthly check out of the plan. So all those things have to coalesce. On the next slide, Jeff. What's interesting is when I got into this business, I started my career in the investment industry in the early 90s. And as I mentioned, in 1994, I got introduced to the 401k and worked on the product side. So I got very technical with it, and then decided to transition to an investment professional in the late 90s. And in doing so, I wanted to have the opportunity to use my retirement expertise and my background in that space to provide advisory and consulting services to organizations. And I spoke to senior folks, individuals who were very well tenured on the investment side, and specifically sought out those who had experience working with retirement plans. And I remember, probably because I was so young and impressionable at the time, speaking with an older gentleman, and he said, if you know retirement plans and you want to be a good investment professional, I encourage you to seek out and try to work with pension plans. They're very good long-term clients. The investment portfolios are very long-term in nature, and he stressed how simple they were. They're balanced portfolios. If they're more conservative, they're 40% equity, 60% fixed income. If they're a little bit more aggressive, they might be 60% equities, 40% fixed income. And they're not worried about day-to-day volatility because they can amortize these losses over years. They have very long-term investment objectives. So they're great clients, and they're relatively simple to work with. Well, once I began to sink my teeth into pension plans and to work with actuaries such as Jeff and his team, I began to realize that, wait a minute, these are not simple at all. And I think that there are a lot of investment professionals that work with pension plans who are looking at it purely from an asset management standpoint, right? Balanced portfolio, maybe a little bit more conservative, maybe a little bit more aggressive, depending on the overall objectives, and that's it. But the reality is that is not at all the case. If you're working on a pension plan, if you're an investment professional such as myself and my team working on pension plan clients, we not only have to be asset managers, we also have to be risk managers, and we need to be liability managers. And we also need to understand the risks that our clients face, how the plan can impact those risks, and then work with the client, work with their actuary to identify, understand, and ultimately prioritize the risks that each client faces. So on this side, there is no universal ultimate pension portfolio that can apply to any plan. As I started my presentation with, every single pension plan that I've ever seen is entirely unique unto itself because all of the combinations of factors that were outlined on the prior 3 slides. So putting it all together, what should a portfolio look like? Hard to say. Again, no universally applicable advice here, but there is a universally applicable process, and that's bringing everyone to the table. So I call it the plan governance stakeholders. This is obviously you as the organization, your pension or retirement plan committee. your actuaries, who are hopefully also providing actuarial consulting services, and your investment professionals, which again should also be asset managers, risk managers, and liability managers. And if you're a large enough organization, your plan subject to an audit, you should also include professionals like Derek and his colleagues who provide auditing services, and make sure that everyone understands all the unique subtleties and nuances for your plan. Your investment professional should be fluent in actuarial terminology and understand the impacts your organization may face from any potential investment outcome in the plan. If it exceeds the actuarial rate of return, if it fails to meet the actuarial rate of return, if the asset duration is mismatched from the liability duration and interest rates go up or interest rates go down, what sort of ripple effects will that have through the plan to the organization? And ultimately, all of the stakeholders, all the plan governance stakeholders should be able to work hand in hand, agree on the approach, and be able to clearly explain that approach and the framework to those within your organization who are responsible for overseeing the plan. And I really can't undersell that last point. There's a lot of work that Derek and Jeff and I can do, and it may be excellent work, but if we're not able to explain the approach and what we're trying to do with the client, then we certainly have failed in that regard. So it's very important to make sure that we understand all of the inputs, all the potential ramifications to the organization from the plan, and that we have a very clearly defined and well-explained strategy. So the process begins by working through all the considerations that I outlined on the prior slide, and then you as an organization helping us prioritize each one. And that includes us explaining in each instance, okay, if you go in this direction, you could be facing this risk. If you go in this other direction, you could be facing these other risks, and help you prioritize and develop various levels of sensitivities to each of those risks, which then helps us design a portfolio that can work to mitigate those risks in order of priority. As Jeff mentioned, he suggested having a written funded strategy, or funding strategy, I should say. On the investment side, we want to make sure that there is a written investment policy or investment strategy document that is agreed upon by everyone who has a stake in your plan. And ultimately, the construction of your pension plan portfolio is going to reflect your plan objectives, overlaid with your prioritized sensitivities, particularly financial sensitivities, and again, overlaid with your goals in the plan to make sure that you're meeting the obligations that you have. And on the next slide, we'll talk a little bit more about some of that risk mitigation and some of the factors that go into it. But whatever investment strategy you employed ultimately should be truly custom tailored to the objectives of your plan and your organization's prioritizations of the risks that you may face and the potential impacts of those risks to your organization. So as we work through as a team and work through that process with our clients, we want to make sure that we categorize each of those risks by their potential impact to the plan and ultimately to the organization. We've had a lot of very deep conversations about actuarial target rates of return with our clients, again, depending on what the status of their plan is, whether it's actively accruing, partially or soft frozen or fully frozen. And that rate of return should be very realistic, very sustainable. It should match how the portfolio is ultimately constructed. The next step is something that we do routinely, which is stress testing the portfolio. So again, you prioritize all the risks that the organization can face. You design a portfolio that is designed to mitigate those risks while still trying to deal with the liabilities of the plan. And you stress test that portfolio through all sorts of historical market outcomes to say what could have happened in the past if we were invested this way under these circumstances. So you can go back and you can back test against very challenging markets like the mid 70s. You can test against the tech bubble bursting. You can test against the financial crisis. In relatively short order, we'll be able to stress test against what happened last year when the pandemic got underway. And then you also use current capital market assumptions to begin to forecast. So you have this portfolio that you've created that's designed to mitigate risks and to try to match the duration of assets and liabilities to whatever extent may be necessary. And then you stress test it through historical market outcomes, and then you overlay expectations given current capital markets assumption, and you update that on an annual basis. Jeff was mentioning the concept of liability-driven investing, or LDI. You may have heard that term talked about either by your investment professionals or your actuarial team. Generally speaking, if you have shorter-term goals or risks that you're trying to mitigate, you're generally going to use shorter duration assets. And you can do that by looking at your plan demographics, looking at the distribution of the duration of your liabilities. And if you want to segment those liabilities, you can invest assets in your plan to match those durations. So again, depending on what your demographics look like, what your duration ultimately looks like, the distribution of that duration, as investment professionals, we can buy typically fixed income securities of different durations to try to match those liabilities. And typically when you're doing that, you're trying to hedge interest rate risk so that as interest rate rise, your liabilities fall, but the assets that are hedged to those liabilities may also fall. So they're moving in lockstep, and you're doing that because you're trying to mitigate the potential impact of or to your financial statements as an organization. So again, just an example of using liability-driven investing strategies to match the duration of assets to the duration of liabilities, which again can be done in part, it can be done in whole. Most often it's done in segments. It's almost never done with 100% of a portfolio because it would take a pretty unique combination of circumstances and objectives in order for that to happen. And then if there are particular risks to your organization that are very high priority that you are particularly sensitive to, whether it's for regulatory reasons or perhaps covenants that you may have, you can apply very, very specific hedging strategies to make sure that those high priority risks are dealt with accordingly. So again, the process is understanding all of the risks, prioritizing the risks, making sure that you understand the implications of each type of investment strategy in your pension plan and how that may ripple through to the organization, and then applying a sustainable actuarial rate of return to the portfolio that's been stress tested both for past markets and looked at prospectively based on where capital market assumptions are today, and really coalescing all four of those areas that I mentioned on the prior slides. So I believe that is the end of my presentation, and I will now turn the webinar over to Mr. Graves.
Thanks, Joe. And before we get into the financial statement impact of your defined benefit plan, I'm going to provide just a brief introduction about myself and Wolf & Company as well. My name is Derek Graves, a principal in Wolf & Company's Audit Services Group. I've been with Wolf for about 20 years with a focus on employee benefit plan audits, and I lead our employee benefit plan audit practice and our employee benefit plan services team. As a firm, we audit about 80 plans annually that include defined contribution plans, defined benefit plans, as well as health and welfare plans as well. And the plans that we work with range in size from 100 participants all the way up to about 100,000 participants. A little bit of background on Wolf & Company. We are a 100-plus-year-old firm, and we have offices in 4 locations in Boston and Springfield, Massachusetts, Albany, New York, as well as Livingston, New Jersey. And as a firm, we do stick to our core competencies, providing audit, tax, and risk management services to our clients. Some of the assurance services that we do provide are financial statement audits, employee benefit plan audits, SOC reporting, high trust, as well as PCI and the payment card industry compliance. Wolf is registered with the PCAOB as well as the AICPA Center for Audit Quality, and also the AICPA Employee Benefit Plan Audit Quality Center as well. And I mentioned that we do perform tax and advisory services as well. So some of those advisory services include IT audit, cybersecurity, business continuity planning, internal audit, regulatory compliance, as well as a virtual CISO offering. And then additionally, Wolf has an enterprise risk management software solution that we call Wolfpack, which is used by our clients to automate the identification of risk, threats, and control gaps within their entity. As a firm, we have about 300 professionals, and we are a very niche-based firm, the largest being financial services, which includes banks and credit unions and fintechs as well. So we work with about 350 financial institutions and fintech clients. We also work with asset managers, broker-dealers, and investment funds through our financial services niche. The other niches that we participate in and have a focus in are healthcare, manufacturing, distribution, and retail, as well as technology. But Jeff, do you mind sliding to the next slide, please? So I'm going to be discussing the impact of the defined benefit plan that it's going to have on your credit union's financial statements. The pension benefit is part of the compensation that's paid to an employer for services. So generally, the amount of benefit that's going to be paid depends on a number of future events that are incorporated into your plan's benefit formula. That's often including how long that employee or any of their survivors may live, how many years of service that employee is going to render, and the employee's compensation in the years immediately before retirement or termination. So conceptually, the way the guidance tries to lay out the compensation cost is that it should be recognized in the period in which the employee renders those services. Although the complexity and uncertainty of pension arrangements may preclude that achievement of that goal, a fundamental objective of the guidance that the Financial Accounting Standards Board puts out is to approximate more closely the recognition of compensation cost of an employee's pension benefits over that employee's service period. And so as accountants and auditors, what we do is we look to the guidance through the standards that relate specifically to compensation and retirement benefits. And that provides plan sponsors as to the accounting impact on your financial statements. So that defined benefit plan is going to have an impact on all of your financial statements, the balance sheet, the statement of income, the statement of comprehensive income, and the cash flows. And you heard Jeff, as well as Joe, talk about the funded status. So the funded status is what impacts your balance sheet. And you're going to need, there's a couple of different components that kind of make up that funded status. You know, the first being is that you're going to need a team like Jeff at the Angel Pension Group in regards to an actuary who's going to help determine that projected benefit obligation. And what that represents is the actuarial present value as of a date of all the benefits attributed to the pension benefit formula to employee service rendered before that date. And they also take into assumptions as to future compensation levels. The other component is the plan's assets that are held. So that's where Joe and his group come in regards to the investment management. So to determine your funded status, what you need to do is then compare that projected benefit obligation to that of what the plan assets are, the fair value of those assets. So if the projected benefit obligation does exceed the value of the plan's assets, you're going to recognize a liability on your balance sheet. If it were the inverse, in which the fair value of the plan assets exceed that projected benefit obligation, you recognize an asset on the balance sheet. Now, the fluctuation does not necessarily all go directly into your income statement. Through some of the portion of it does, however, which is what they consider the net periodic pension cost. And that is defined as the amount that is recognized in an employer's financial statements as of the cost of a pension plan for the period. And there's components of that net periodic pension cost that include what they refer to as service cost, interest cost, the actual return on those plan assets, gains and losses, and any amortization of any prior service cost or credits. Now, the service cost is defined as a component of net periodic pension cost that's recognized in a period, determined as the actuarial present value of those benefits attributed by the benefit formula to services rendered by the employees during that period. The service cost component is a portion of the projected benefit obligation, but it's unaffected by the funded status of the plan. One other component of the net periodic pension cost is the gain or loss, which is defined as the sum of the difference between the actual return on plan assets and the expected return on plan assets, which is recognized through accumulated other comprehensive income. So that gain or loss component is the net effect of the delayed recognition of gains and losses in determining your net periodic pension cost in what they refer to as AOCI, except that it does not include changes in the projected benefit obligation that occurs during the period and deferred for later recognition in net periodic pension cost. So before we get into a little bit on the impact on your financial statements about the items that Jeff described in the American Rescue Plan Act, a couple of notes on how a low interest rate environment does impact your organization's pension liability and your annual pension expense. So that pension liability does represent the future benefit payments that current and future retirees will receive from your pension plan that is expressed in today's dollars. And that is the present value of the future benefit payments. The present value is estimated based on the current interest rate environments. And it's also referred to as the plan's discount rate. And that lower rate will increase the present value of your future benefit payments, which is your pension liability. Likewise, if there are higher rates, it would have a lower pension liability. When you have the higher pension liability, of course, there's a negative impact on your balance sheet due to that funded status and through your AOCI, as well as your pension expense might be higher as well. Jeff did mention with the American Rescue Plan Act, it has two key areas, which are the funding interest rates and the amortization of funding shortfalls. As Jeff did mention, the interest rates will be higher for funding purposes, and therefore will significantly reduce your required contributions currently and into the future. So this was really designed to help companies with cash flow. So it's really more of a cash flow impact. And those higher interest rates are going to result in lower funding liabilities and lower required minimum contributions for most plan sponsors. So that's going to result in a reduction in the funding target liability each year. Now, the amortization piece in regards to the shortfall amortization relief is that you will be able to reset to zero, and then you can amortize that shortfall over 15 as opposed to 7 years. So again, this is going to help with cash flow issues. The extended amortization period for funding shortfalls will give plan sponsors a longer period over to which to pay their long-term pension liabilities, and generally are going to require a lower contribution. So if plan sponsors are reducing the contributions to the defined benefit plan, it may result in a negative impact to the funded status, which of course would increase the liability that's on your balance sheet. And as Jeff had mentioned, that interest rate relief does not impact your plan liability for ASC 715 purposes in doing those calculations. It's more of an impact on the contribution funding requirements. A couple of other issues I'd just like to point out. One that Jeff did mention in regards to the PBGC premiums, that interest relief does not impact your plan liability for purposes of calculation and determining those premiums. So the Act does come with a chance of higher PBGC premiums since contributions will be lower, which of course could negatively impact your cash flow. Another thing to keep in mind too is that if you do elect that 15-year amortization shortfall for the unfunded liability back to 2019, it might impact your Form 5500 filing as well. And as Jeff had mentioned, we are still waiting guidance on what that impact could be, but you may have to go back and amend your Form 5500 for 2019 since it was already filed and those contribution requirements are going to change. So to wrap it up, in discussions with our clients that have defined benefit plans, we are suggesting the plan sponsors review opportunities and options and impacts for the application of these new funding provisions with their actuary in order to best align the outcome for this pension funding relief with their corporate objectives. And with that, I'll send it back over to Stephanie for any questions.
Great. Thanks, Derek. And also thank you to Jeff and Joe for all of your insight on this pension topic. So I do want to encourage the audience to send any questions in they may have regarding to any of the topics that were discussed today. And we can begin going through those questions. So it looks like the first question we received is, how do I determine which plan year to implement the changes?
Yeah, so it sounds like, Stephanie, that's probably for me. So to determine which plan years, Derek pointed out, really depends on whether you were looking for cash relief or you were thinking more that as a credit union, we had the cash available to fund our plan. We wanted to keep up the liabilities. So an example would be if you went back to 2019 to change the shortfall amortization and reset it, then you've already contributed for that plan year at a higher number. Presumably that would develop a credit balance or something called a pre-funded balance. So if you were looking for just the go forward basis, you wouldn't need a funding balance because you're continuing to put in an amount higher than the minimum. So the answer to that is, if you're interested in funding relief going forward, then you could look at the impact of putting 19 or 20 in terms of the legislation effective date. So it really depends. If an organization is not looking for instant cash relief, then you would typically go with the later effective dates of both the interest and shortfall. If you're looking for instant cash relief, you would go back historically and run those projections.
Great, thanks, Jeff. And I believe we had one more come in that is directed towards you. And the next question is, should the plan adopt a more formal funding policy because of the funding rule changes?
Yeah, so as we went through in the presentation, you are, from a funding point of view, you are having the option now to put a much lower contribution in, even at zero, possibly for many years, depending on the funded status. So if you're developing from one of those key areas of funding policies, a different policy than your required minimum, then we think it makes sense to formalize that. As Joe pointed out, we would normally have an investment policy. A funding policy may become more popular in terms of a formal adoption because you're deviating or going away from the required ERISA, so your plan doesn't become underfunded. So we would encourage the adoption of a formal funding policy if it's going to be something other than just a required minimum under ERISA.
Great, thanks, Jeff. Looks like those are all the questions that we have received today. I do want to encourage the audience to direct any questions they may have to our presenters. All of their contact information is going to be available in the presentation that you will be receiving after the conclusion of this webinar. Like I had previously mentioned, you will receive the recording to the webinar as well as the presentation in an email later on tomorrow. So with that, on behalf of Wolf & Company, I just want to thank our presenters from the Angel Pension Group and the Kelleher Corbett Group at Morgan Stanley, as well as Derek for presenting today and providing their insight. And with that, we are all set, and I'm going to close down the webinar. Thank you, everyone, for joining us today. Have a great afternoon.
Thank you all.
Thank you, everyone.
Time.
Thank you.